Good morning and welcome back to Real Estate Mindset. Happy Monday. Really happy to be here to start the week with you guys. Sorry I wasn't here on Friday. I had a field trip to go to with my daughter. With my daughter, what am I talking about? With my daughter, but I will be back this Friday. And this Friday, we will start doing a market analysis. A lot of people love the market analysis. So that's what we will be studying this Friday. So bear with me again. I'm sorry, but welcome back, you guys. And today, what we're really going to dig into a lot today is the overwhelming amount of government deficit spending. Plus, I'm going to go into what is a real price crash versus a nominal price crash. So we'll look at that. And then we'll do our usual stuff, guys. We'll review about 3 videos pertaining to real estate. We'll go over liquidity, mortgage interest rates, and things of that nature. But I'm going to dig into that deficit spending. And real quick from Justin, you see I threw his comment on the screen. What Justin is saying is this is the most confusing market in history. And I would agree with that because, Justin, it's also the most government deficit spending and money printing in history as well. So it is very, very confusing. And real quick, guys, I wanted to say good morning to Josh, Dean, Ray, Mr. Watson in the house, big member of Discord. Also, Christy, good morning, big member of Discord. Obviously, Trey, big member of Discord. Don't move. All the usual suspects. I don't know if Les is in there. Les, stop spending your money. We have our buddy living in Omaha. I'm sure he's going to ask some great questions today. You guys, don't forget to throw up your questions, and I will try to address as much as possible. There's Millennial Minimalist as well. Good morning. And what we're going to do, guys, is let's get started right away. And first, let me show you the economic calendar because this is a big week. This is actually a huge week as far as the labor market. And we have almost every single day where the Federal Reserve chairman or some chair is going to be speaking. So today, actually, the chairman is going to speak. Philadelphia Fed President Tom Harker is going to speak at 12 p.m. today. Now, on Tuesday, we also have more Fed chairs speaking. You see that here, Michael Barr. Now, on Wednesday, we have ADP employment, job openings, another talk from San Francisco Fed President. On Thursday, we have initial jobless claims. And also, you may want to watch this one. This was really important, you guys. We have Federal Chair Jerome Powell testifying in Congress. Okay, so that happens on Thursday. You're not going to want to miss that. On Friday, more unemployment information, plus another Fed speaker. So every day this week, the Fed will be talking about the economy, about what they're doing. So I'm a little bit anxious. Plus, again, you guys, we're going to be getting our data on the job market. Which a lot of people are confused about the job market. So what I'm going to do now is let's move on to our great economy. So I'm going to start talking to you guys about deficit spending. And basically, we're in a situation right now, and let me know if you agree by commenting below. The Fed is fighting the Treasury. The Fed is fighting the Treasury and losing. Okay, again, let me know if you agree with that. But the Fed is losing a battle with the Treasury because of the overwhelming amount of spending. And so what I want to do, guys, is I want to start by taking you to this graph right here. Now, this is from fiscal data, and I want you guys to really put in perspective how much money that the government doesn't have that they're spending. And real quick, just in case you don't know, I'm only going to talk about the deficit spending. I'm not even going to talk about all the other spending, only the deficit spending. And what that means is the government is spending money that they don't have. That's the deficit. They don't have the money, but they're still spending it. Okay, so let's go back here. Now, here's where I want to point your attention to. First of all, and this is super depressing, guys, the last time that we didn't have a deficit was in 2001, 23 years like Jordan. Okay, so 23 years ago was the last time. Isn't that crazy to you? But here's what I want to show you guys. So basically, right in the front end of the recession, 2008, okay, the recession hit, and what the Federal Reserve and the government had to do is they had to stimulate the economy, okay? That's called quantitative easing, or that's one of the ways to call that quantitative easing. So they started pumping in money the economy to support it. And you guys can see it peaked in 2009 at $1.42 trillion in deficit. And obviously that waned down. You guys can see it kind of bottomed out in 2015 and then started picking up a little bit. But look at this, you guys. When we were on lockdowns, I just want to remind everyone, okay, in 2020, the government deficit spending, okay, was 3.1 trillion with a T. $3.13 trillion in deficit spending in 2020. Okay, we were on lockdowns, fine, it makes sense, whatever. But the problem here that I'm trying to paint, you guys, is the spending didn't stop. In 2021, the government deficit was $2.7 trillion, okay? Now, at that point, it should have stopped, all right? We're in 2022 now. It should stop, right? Things should stop, but that didn't. In 2022, the government deficit spending was $1.38 trillion, and in 2023, it went up. The deficit somehow went up in 2023 to $1.7 trillion. Healthy economies don't need that type of stimulation. $1.7 trillion in stimulation in 2023. I thought 2023 was a year to celebrate. Didn't we have great GDP? Wasn't the labor market resilient? Well, no wonder why we have a deficit of $1.7 trillion. Oh my God. You guys, the amount of deficit spending over the last 4 years it's hard to fathom. And to put this in perspective, okay, so remember this, and I'm going to show you just so you understand what I'm saying. In 2023, the government deficit was 1.7 trillion. Okay, but look at this. In 2023, GDP growth on a year-over-year basis, okay, so increase of GDP increased in 2023 by $1.61 trillion. You guys, that GDP increase was less than the deficit. So it's fair to say that in 2023, without the overwhelming amount of recessionary government deficit spending, it's fair to say without that, there would have been no increase in GDP. Because if the GDP went up 1.61 trillion in 2023, like you can see right here, but yet the deficit was more than that at 1.7 trillion, that means that everything is artificially being propped up. Change my mind on that. You don't need this type of stimulation for strong economies. You guys, the Federal Reserve is in a very difficult situation, again, because they're fighting the Treasury. But look at this, okay? So this is even worse. Now what I'm going to do is I'm going to compare M2 money growth, okay, from October to now, compared to the deficit spending from the new fiscal year. Now, obviously, guys, the fiscal year starts in October. So I'm going to show you guys what the deficit is from October to January, and then we're going to look at M2 money growth, and we're going to see, is the M2 money growth the same as the deficit? Because a lot of people are saying M2 kind of tracks, it doesn't fully, but kind of tracks the S&P 500. So I'm wondering, is the all-time highs in the stock market as a result of the deficit spending? But look at this, you guys. So far this year, look at this number. So far this year, as far as government deficit spending, the government has spent in deficit $531 billion. And that's only to January. That is not counting February. So from October to January, you guys, $531 billion. And if you guys really want that broken down, I found this for you. This is the kind of the books that they're showing us, but it goes from October, November, December, January. Do you see that? So just 4 months, you can see that $531 billion in government deficit spending. Now, this is the M2 money growth. Now, the interesting thing is actually this did update about a week ago, and M2 actually went back down. But what I wanted to point out is if we compare the bottom, which was right here over the last year, right? So about right here, October of 2023. If we compare this M2 money growth from October to current, this represents M2 money growth of, you guys ready? $91 billion. Okay? So this is what I'm saying. The government deficit spending was 5 times more than the actual M2 money growth. How's that possible? How does M2 only go up 90 billion when the deficit spending is 532 billion? Who's taking the money? Who's taking the money, you guys? Do you guys see what I'm saying? But not only that, M2 went down regardless. So M2 did go down from December and January, but the M2 money growth is 91 billion, deficit spending 531 billion. I think the government has a spending problem, you guys. Comment below. Do they have a spending problem? I mean, they're spending money. We're paying it in the form of inflation. If there wasn't so much stimulus in the form of that government deficit spending, the show would already been started with the correction, with the bust, with the crashing. But they keep propping it up as if we are already in recession. Now, what I want to do is I want to talk about one of the kind of the bullish narratives, the one that I think makes the most sense, which is basically that everything is going to stabilize and normalize. And Jeff makes a good point of this. And really, what this is called, basically, we're going to go into real versus nominal. And I'm going to explain to you guys why I don't think we're going to have just a real crash. Okay. Now, what a real crash is basically adjusted for inflation. So, for example, according to Redfin, in 2023, home values on average went up 4%. Okay. And this is how this works. So, if home values went up 4%, but yet shelter inflation was 6%, that means that the real numbers, home values went down 2%. Because if they went up 4%, but inflation is 6%, that means there's a real price decline of 2%. Okay, so that's real. That's the real crash. That's the narrative. Okay, but I don't think it's going to just end with a real crash on a nationwide average, because the consumer lacks the ability to sustain the unaffordability. Okay, now a nominal crash is like, okay, home prices went down 15%. I think we're going to have that. I don't think we're going to have as much as a real crash, like, Jeff, but I understand their points. And again, I'm going to show you the health of the consumer and why I don't believe it's just going to be a real crash. It's going to be more of a nominal crash. Let me throw up some info for you guys right now, starting with Case-Shiller over CPI. Now, this is one of the primary reasons I don't think we're going to make it, because the consumer gap of affordability is like never been this bad. The fact that consumers have actually maintained so long, to me, is absolutely shocking. And when I say maintain, what I mean to say is that they're still spending money like pretty much like crazy, like we're still in lockdowns. But you guys, the bottom line, okay, is CPI. That black line right there, you guys can see how CPI has basically stayed the same. That's that black line on the bottom. Now, Case-Shiller, this red line, is an indication of home value growth. Okay. Now you guys can see the divergence during the GFC. We had a market crash or deflation during the GFC, and that got back down to being close to the CPI numbers. Now, however, ever since about 2022, that gap has been widening. And right before lockdowns, you guys, and I remember this because I completely rebudgeted my entire household, because there is a slowdown happening in 2019. If you were in the industry, you remember what I'm talking about, and you see it in this chart. But instead of that correction, instead of that gap narrowing, we went on lockdowns, and it went parabolic. It shot up, and this is prices again. So one of the reasons that I'm saying this is, when we look at the total picture, CPI, and I'll break this down into consumer credit cards, I'll show you guys savings, I'll show you guys all of that. But CPI kind of looks at all of those things, and that gap is bad. And that is, again, I don't think it's just going to be real. I think this is going to be nominal, because back in the 70s and 80s, when it was more of a real crash, the consumer was way better off as far as wage growth, the ability to save, not being an overwhelming consumer credit card debt, like things like that. But right now, the world is way different. It's way different. Now, let's move on to the next thing, you guys. PE ratio is even worse. So this is the home price to median household income ratio in the United States, and this is over 70 years. Okay, so this is how much money people make annually compared to how much the average home price is. Now, again, this is going back 70 years. This goes back all the way to 1954. And if you look at the 70s and 80s, which is the bull case a lot of the times, the PE ratio is, look at this. Even though home values went up 120% during this time, the PE ratio was still under 5, which means values could sustain because people could afford it. Right now, you guys, we are at a PE ratio. This is really shocking, actually. We are at a PE ratio of 7.58. That is the highest PE ratio for houses that we have ever had in the history of the United States, and that's higher than the Great Financial Crisis. During the GFC, we didn't even hit 7. We hit 6.79. And look at, during the deflationary or when prices were going down, look at how that dropped. You see that? That dropped. And it got down to under 5. And again, you're normally under 5. Do you see that? historically up until we got to the 1950s. So the 1950s, it was above 5. But from the 50s to what is this, 2000s, it was under 5. It's a scam. You guys, this is a sham, in my opinion. The whole fear of missing out is just so bad. You need to use data. If you want to go buy a house, fine. But for the love of all that's holy, please make me feel better by using data to find the deal, right? Don't use your emotions. You guys see how overvalued things are from a PE standpoint? From a PE standpoint, that's the asset bubble, okay? Right there. You can't overlook that. If you're bullish, you have to take into account PE ratio. Now, whether or not you think that gap is going to lower, that's a different story. But the PE ratio is out of control. And look at this, you guys. With consumers, this is the personal savings rate. This just updated February 29th, so about a week ago. The savings rate for households is only 3.8%, and it's going down. What this means, y'all, is consumers can't save. They can't save. Maybe you have $100,000 in home equity. Good luck cashing that out, going from a 3% to a 7%. So really, it's just that wealth effect. If you think you're rich and you have all this equity, then cash out. I dare you to. I'm kidding. Don't do that. My point is, in order to cash out, you're going to be paying $1,000 more a month. So do you really have that equity? Yeah, you do if you sell, right? But my point is, consumers can't save. Things are so unaffordable and out of whack. Now, again, whether you agree with me, whether or not we're going to have deflation, that's another subject. All I'm pointing out here is consumers can't save money. And again, going back to the 70s and 80s, and Jeff, are you online? I don't know if Jeff is online. And I really appreciate Jeff because I always look into these things a lot. But look at you guys, going back to the 70s and 80s, look at the savings rate in 1971. The savings rate in 1971, my God, it was 14.7. So again, I understand the real versus nominal, but I think it's going to be nominal. I don't think it's just going to be real, because instead of 14.7% household savings, we now have 3.8. Way different, way different. And that was like, it was really, really surprising, because it maintained double digits for a long time, up until about, actually for almost from the 70s into 80s, you guys, it was double digit savings rate. Isn't that remarkable? So people aren't saving anymore, but that's not all. Okay. So not only do we, have a savings issue problem generally from spending habits and also inflation, it's a combo. Look at the credit card spending habits. Credit card spending habits have absolutely exploded. We went from 736 to 1.04 trillion in 3 years? So in 3 years, consumers spent $250 million in consumer credit cards. So again, we have a consumer that things are so unaffordable, they can't even breathe. They can't save money. Wages aren't keeping up. People are now drowning in debt. Yes, we have lag effects because of deficit spending and all the money still in the system, but the consumer is not in good shape overall. Some people are, I'll admit that some people are, but overall, you guys, consumers are hurting. And not only that, let's go in and let me show you guys the job market one more time. Okay, so this is the last thing, and then I'll move on to our first video. You're looking at the job market. All right, so this first little thing I highlighted is November. This is December. This is January. You guys, we've been losing full-time jobs, okay? A lot of full-time jobs. From November to December, we lost 1.5 million full-time jobs. And then from December to January, about 60,000, while we have been going up in part-time jobs. So, the thing is, here's the thing with the labor market. We kind of have a part-time job labor market that's on fire. Full-time job labor market starting to unravel, also tainted because of severance. So we really don't know what the true unemployment rate is until all of the severance has ran out. But it's not good, right? Losing full-time jobs and having that replaced by part-time jobs is not a sign of a great economy. It's not a sign of a traditionally great labor market. But I will say, comparing it to the GFC, there's no comparison so far. The GFC, we didn't even have part-time jobs. So long as there's part-time jobs in the economy, I think people are still going to be paying their bills. Now, will those spending go down if they lose their job? Yes. But again, if they can still get a part-time job, I think it's going to be a little bit safer, a little bit more of a soft landing per se, because of the labor market, because if people could still get money. And again, that wasn't like that back during the GFC. So now what we're going to do, Hope you guys like that, by the way. Do me a favor, comment below. Did you guys like that? I haven't talked about government deficit spending this whole time, and I haven't talked to you guys about real versus nominal, so I hope you like that. We're going to go into our first Supreme Court puts Trump back on Colorado Republican primary ballot. Oh, so the Supreme Court just ruled. I don't want to get political, but the Supreme Court just ruled on Trump. Very interesting. Very interesting. Anyways, first video I'm going to play for you guys is, oh my gosh. Okay, I'm not trying to pick on this lady. Okay. But when you listen to it, are you creeped out? I want you to, are you creeped out? Like, I'm creeped out. Like, she creeps me out for some reason. But it's a builder being like super optimistic. She's basically saying that rates hit 8% so fast, it messed with people's minds. So 7% is okay. But what I also want you guys to pay attention to is later on in the video, she's going to tell you guys why the new home builders are winning and existing home sellers are losing. In other words, existing home sellers can't compete with builders. I mean, that's what it is right there. So we're going to go into our first video right now. Let me put my timestamp on, and I hope you guys enjoy the video. Let me know the audio is okay, please.
Rates continue to impact demand from potential home buyers. The CEO of one of the nation's largest home builders joins us right now. Cheryl Palmer is Taylor Morrison's chairman and CEO. And Cheryl, thanks for coming in today.
It's great to see you. Thanks for having me.
Let's talk a little bit about how things are going, because we saw interest rates start to come down and then rise back up. What does that mortgage rate mean for the buyers? What does it mean for the builders?
Yeah, you're right. It's been a little bumpy over the last, 12, 18 months. And in the fourth quarter, we saw rates drop back into the sixes.
Yeah.
And what was so nice about that, Becky, is the consumer's actually in a very different place than they were a year ago, 18 months ago, where they thought rates were going to, be back into the threes or maybe low fours. So the consumers kind of met us halfway. So when they dropped into the sixes, we had the ability with all of our tools to get them comfortably into 5% interest rates. And I think the consumer recognizes, by any long-term historic standard, that's a really good thing. Today, they've moved back up. I mean, the 10 years, at 4.3? Yeah. Rates have moved into the low sevens. Interesting, we just reported our earnings, and last quarter, the average coupon of all of our closings rate was like 6.7%. So it really tells you how far the customer and the consumers come. But once again, we have the tools to get them into the low fives, the mid fives, really personalize a rate based on what their needs are.
What tools do you use, and what does that mean for your profitability?
Yeah, it's a number of different tools. And I think not painting all customers with one brush is probably the most important part of that. Some customers need a little bit of help with cash at closing. Some want the confidence of a 30-year fixed rate, and so we'll do forward commitments. Some need a temporary support. So they might do a 2-1 or 3-2-1 buy down. That 6.7 would be the final coupon rate, but it tells you what they expect to have happen. The cost of when we first started doing this a couple years ago was actually much more significant, because we were trying to go from the sevens down to 3.99 or 4.25. Today, when we're looking at 5.5, 5 and 5.75, it's just not as bad.
Meaning customers are thinking, okay, 5.5 sounds pretty great to me right now.
That's right.
Versus 2 years ago, that was sticker shock.
As silly as it is, they went to 8 so quick that I think it kind of reset the customer's mind, so that they don't expect that they're going back to 3.99.
Sure. Every time Diana looks on, she says, yeah, it's not a demand problem.
It's not a demand problem.
So why aren't you building more? Why aren't home builders matching in? If you can sell, why don't you match with the demand? Why can't inventory match the demand? It takes time, or?
Well, we have, if you look at the new home inventory across the country today, I would tell you it's a really healthy, probably 7 months of supply. The real important detail there, Joe, is what is the finished inventory, and that's relatively low. So I think that's actually a really nice balance, because I think we're like 1.4, 1.5 months of finished inventory. I want to have inventory at all stages of the production cycle, and we do. The resale inventory is also pretty tight, and that's the lockup effect you keep hearing about. I think we just moved to about 3 months, but the devil's always in the details.
How's land? Do you buy big plots of land? I can remember in years past, Lennar, somebody got got in trouble. They had spent so much money, and then the land prices dropped, and they were stuck with it and had to write down. But how do you do that? Do you buy a huge swath of land to put up a development?
We do. We're developer first.
Is it based on mortgage rates too, or?
Well, when you underwrite the land, recognize land I'm buying today is not coming to market for 2 to 3 years. So it's really the land that I bought, back in 21, 22. When I look at Taylor Morrison, we still have just under 50% of our land that's purchased pre-COVID. So it's actually from what it's sitting on our balance sheet, it's in a really good place. But yeah, we buy parcels, our average is probably 150 lots, Joe. But we'll do, we build for all segments. So when I think about our active lifestyle communities, those could be 500, 1,000 units, golf courses, lakes, big amenity packages.
But to put all of those loans, I mean, interest rates have gone up, so it means you have to pay more for every one of these purchases you make, for every one of the builds you do. What's the limiting factor right now? Is it, it's too expensive to build the homes? Is it too hard to find people to build them? Like what would be the limiting factor when you look at
so I guess a couple things there. One, all consumers aren't created equally. So when I think about the support that we need to give to that first-time buyer, they may not have the equity in the house that a move-up or a 50-plus, lifestyle buyer has. So most of our incentives back here are going to really support that first-time buyer. You look at the average equity that's out there today.
I don't know, guys. I think they're doing that to support their bottom line. So anyways, I'm going to end this real quick. Let me know what you thought. You guys were beating her up in the comment section. I saw that. So mean. I don't know if that looks like Helen Hunt or not, but interesting stuff there. So anyways, just so weird, right? Just so weird. I don't know. I got a really weird feeling, but I like that she's pointing out like, hey, we're new home builders. We could do all kinds of stuff. We have this magical paintbrush, even though some new home builders are going bankrupt, and I've done that video this morning. So some new home builders, smaller ones, are already going bankrupt, but they can finagle things. They could give down payment. They could give all these different types of incentives to purchase. Now, here's the thing, you guys. So she just said that we know that they're offering insane incentives, but remember, we also know that according to Fannie Mae, they are supposed to report those incentives as sellers' concessions, which are not happening. Okay, so just remember that. You heard it from the horse's mouth. That's what they're doing. But is it reporting on the appraisals as required by Fannie Mae? No. Maybe here and there it is, but overall it's not. So there are massive problems. Real quick, guys, let me go back here. I want to show you guys this real quick, and we're going to move on to our mortgage update. But before I kind of go into the mortgage rates, I want to go into some of the things that she said as far as new privately owned housing units completed. So here's our completed. She said 1 month of completions. It's just a game that they play, you guys. They have, they're on pace, and this did drop. So it was on pace for 1 million, but now they're on pace for 857,000. I did not call her a horse. I see what you said, Panda. I did not say that. But anyways, you guys, it's still at pace at 857,000 SFRs. So this is just SFRs. It did go down greatly, though. It dropped pretty greatly here. Maybe it's a New Year thing. But regardless, you guys, they are still building like crazy. You guys still see the months of supply right here. Months of supply, it's 8.3 months, okay? 8.3 months. This has been over this has been over 6 months of supply for 2 years. So you're probably seeing home prices for new houses go down because we've sustained 6 months for 2 years. So if you're all about the inventory game, the law of supply and demand, you have to pay attention and consider that we have deflation with new homes right now. So it's fair to say that if we have inventory increase, which we won't need a lot for existing, and we sustain the inventory, but yet buying demand stays the same, the pressure on prices to go down will greatly intensify. All right. Now, one other thing, if you're in an area and you want to see if there's new homes in your area, you can go to New Home Source. This is a super good site. This was actually just sold to Zandi, I think. I do not, I'm not, if you have nothing nice to say, don't say anything at all. But you guys can come here and see for yourself, like, where's a new home building? And I would encourage you guys to go out there and check this out for yourself. You'll see it's unreported. These are just communities. You can also click homes right here, and it's going to say there's 1,200 homes available in Boise. Okay, communities, it'll list the builders, but this is a good place to come to just to get info on new home building. Especially considering, guys, that the data is so underreported. Moving on to the 10-year. This 10-year has been up today. It got up as high as, oh my gosh, I didn't notice it went up to this high. So it went up a little bit high. It was about 5. Last time I looked, it was about 5 basis points higher. This is going up. Very interesting. We're at 4.22. We've been maintaining a 4%. This has been going up throughout the year. And if the economy keeps running hot, who cares about the deficit spending? But if they keep getting GDP, CPI, PPI, all of these readings, the employment numbers coming out this week, you guys, the 10 year is going to go up. It's going to go up. The only time this is going to go down is if there's if the market's over optimistic. So it'll go down if the market's over optimistic. We've seen that, but also if there's turmoil. So anyways, guys, this is up. So 30-year fixed rate mortgages more than likely will be going up today. But right now, this is what we're sitting at. Okay, now when you go to Google, it's going to say rates are way higher. I would use these rates versus Google. Google has like high interest rates for some reason, but the 30-year fixed rate mortgages right now on conventional is 7.08. You see that FHA right here is lower. So FHA, you guys, has this average of 6.57. So here's the thing, and I try to explain this all the time. There's only one benefit of getting a conventional mortgage, because remember, conventional mortgages have higher restriction. They generally have a higher down payment, and they have a higher interest rate. So if FHA has a lower interest rate, lower down payment, lower mortgage insurance, why would people want conventional over FHA? There's only one reason: mortgage insurance. Basically, the only advantage of getting conventional is eventually you don't have mortgage insurance. Whereas FHA, you have mortgage insurance forever. Unless you have 10% down, it goes away in 11 years. So that's why traditionally conventional is better, the mortgage insurance. That's really the only reason. Now, moving on. This is somewhere where you guys can go to play around with your mortgage payments. I typed in mortgage payment calculator. You guys are familiar with this, but I'm doing something different today, okay? What I want to point out is credit score. All right, I want to show you guys how much your payment fluctuates with credit score, okay? So if I have an 800 credit score, because this is what you should be doing on the sideline. Okay, if I have an 800 credit score, my mortgage payment is going to be $3,333. Okay, but if I have one of the lowest credit scores, okay, it goes from $3,333 to $3,589, which represents roughly $250. Okay, and that's based on a loan purchase price of $400,000. So understand that just by having good credit, you can save as much as $250 a month in this scenario. And $250 a month annually, that's $3,000 a year. If you have good credit, okay, you could save $3,000 a year in fees. So what I'm saying is, hey guys, please work on your credit, because you will save money, and that's how you save it. So there is a substantial savings if you go from 640 credit to 800 credit. And Trey, I don't know if you're online right now, Trey, but Trey increases credit. So my point is play with this. And also, guys, right here's the PMI, and this will also tell you should I put 20% down? Okay, so this is only 5% down, but if I put 20% down, I don't have to pay mortgage insurance. So at 20% down, the payment's now $2,999. So that's about $500 lower, because the mortgage insurance is gone. This is just a really cool site if you guys want to come here to play with it, to kind of just, empower and educate yourself. This is an amortization schedule. I'm really beating this to death here. If you guys get a normal loan amount of $324, today's interest rates on a 30-year, you're going to be paying $458,000 in interest. Okay, bulls? So don't beat us up if we're renting. We're only temporary renting. Okay, I'm only renting temporarily. I don't want to rent anymore, but I'm doing it because it makes financial sense. And honestly, a child will know that. But I want you guys to come back here and just play around with extra payments. For example, if I paid $500 extra per month, my loan would go from a 30-year to about an 18-year loan, and I would save $211,000 in interest. So again, you guys, go there. Play with it. Empower yourself. You don't want to be stuck in any narrative, not my narrative, not the bullish narrative. You want to be stuck with yourself. Well, you are stuck with yourself, right? So be nice to yourself as well. Be your best friend, right? Be your best friend. Empower yourself. Love people, but love yourself first. Anyway, sorry for that. That's a little bit mushy. I get mushy every once in a while. We're going to go into video number 2 now. And this is going to be a video where it's don't expect a rate cut in June. You guys, and I made a video today where some people in the market are saying no rate cuts in all of 2024. So they're saying, if you wanted to date the rate, I'm sorry, you're married to the rate, because the rates ain't coming down anytime soon, absent a crisis, in my opinion. But let's move on to that video right now. And if you guys can, please let me know that the audio is copacetic.
Bets on a June Federal Reserve rate cut after the Fed's preferred inflation gauge saw its lowest year-over-year increase in nearly 3 years. Doesn't tell the whole story, though. Former Fed Governor Randy Kroszner, now professor of economics at the University of Chicago's Booth School of Business, joins us now. So the year-over-year number went down. That's good to see, though the monthly rate, which we highlighted earlier, especially on core, up 0.4% and a 0.6% rise in services. How worrisome is that going to be for the Fed?
I think this is exactly what they are concerned about and why they're not rushing to cut rates. Certainly, we've seen the inflation come down from its peak quite rapidly, but to continue to move down is going to be tough, particularly because wages are not moving down nearly as rapidly. They'd been around 4% when inflation was much higher. They continue to be around 4%, and that's one of the largest costs that firms face, and particularly firms focusing on services rather than manufacturing. So it's going to be a slow decline. The Fed's not going to move too quickly. June is possible, but this is one of the reasons why they want to see more data to see whether the wages start to come down, whether they start to see services prices come down.
What is your sense, we were talking about earlier, about just what's happening in January? There appears to be some sort of acceleration, not just in prices, in parts of spending, manufacturing numbers turning up, and some of the other weaker parts of the economy. Do you think January is unique, or is it telling us something about the rest of the year?
It's always hard to tell from one number whether it is unique or something on a trend, and so that's why the Fed is going to wait to see. I think you can't overinterpret any one number, but you can come up with a number of factors that come in. We're seeing a little bit more weakness in some areas of spending, but we also saw a very generous increase in Social Security payments. So I think that's going to have to work out over the next few months. But I think this is precisely why the Fed ain't moving. Well, obviously they're not moving now. I think it's unlikely that they'll move in May. If things continue to move down, and if we see more signs of labor market weakness, they're then likely to move in June. But I wouldn't even say June is baked into the cake.
So what's your guess right now? 3 cuts this year? Do you think they'll be able to do that?
I think broadly that seems reasonable based on their forecast and based on the way the economy is likely to evolve. But we've been in a really fortunate situation of having this very soft landing. I'm still a little skeptical that we can get there with no pain. And if there's a little bit of pain, then the Fed's going to have to move a little bit more.
You mean economic pain? You mean labor market?
Yes. Yeah, exactly. I think
it hasn't really materialized yet.
Not at all. Now, I think one of the reasons for that is that even though the Fed raised interest rates really rapidly, still inflation was quite high, moved up even more rapidly, and wage rates moved up very rapidly. So you started to see them move up, not quite as much as inflation. Now inflation has come down. Interest rates, real interest rates, inflation-adjusted interest rates are now positive and have been so for about 6 months. Real wage growth rates are now positive. They've only been positive for about 6 months or so. I think firms are going to be less sanguine about hiring now that they have to pay a positive real wage. I mean, it's great for households, not as exciting for firms to be hiring. And real interest rates have become positive really for the first time in decade or so. I think that is going to be kind of a 1-2 punch, which will slow the economy down. Probably not necessarily leading to recession, but I think we're not going to see kind of the gangbuster growth that we've been seeing over the last few months.
All right, guys. So essentially, from what I gathered there, and comment below, let me know what you think. What I'm gathering from that is basically there just needs to be more time. And not necessarily, well, there's many reasons why there's money in the system right now. You could say geopolitical, you could say these wars, but I mean, it all kind of goes back to the money printing, the deficit spending. I mean, we just went over how much the deficit spending is affecting the economy. I mean, the deficit spending was 5 times the M2 growth. The deficit spending was more than the growth in 2023 as far as just the GDP growth. I mean, This is bonkers, you guys, absolutely bonkers. But let's move on to the liquidity update right now. And I'll get that for you guys. Some pretty interesting things actually right here. Let me cue this up right now. This is CME Fed Watch. The market is starting to figure out that they may not get their rate cuts. Okay, so no rate cut in March. Take a look at May. No, we've made so much progress on this, you guys. It's been such a roller coaster ride following this on the channel. I mean, this is great. This is great because we want a tight market so that it comes back to balance. But in May, you guys, 77.6%, no rate cut. That's huge. Look at June. June is 31% chance no rate cut. In June, 31. July, oh my God. July, 11.8%. Look at September. September is even pricing in 3.1% chance of no rate cut in September. Is that crazy? Look at December. Look at the whole year. Okay, so as far as, so they're basically saying, okay, where are we at? One here. So 1, 2, 3. So they're still pricing in between 3 to 4 quarter basis point rate cuts right there. Very, very interesting. Now, moving on, you guys, to the biggest the biggest recessionary indicator, which is the inversion. This is not going to put us in recession. This is just an indicator of recession, is the inversion of the 10 and the 2. We've kind of been balanced here at 35. I mean, we're at 35 basis point inversion. We're now going into 20 months. We're now past 19. Okay, I believe. Let me just double check that. Okay, so July 7th. But anyways, you guys, we're moving on to 20 months of inversion. So we're nearing the second longest inversion in history. I believe the longest inversion was 21. It's possible that we stay inverted the longest time in history. And that makes sense, again, because of all the money printing, deficit spending, all the blah, 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 blah. There's still money in the system that we got to pay for, unfortunately, with our pain and struggling. Now, take a look at the reverse repo market. This is like the suspension system of the economy. This is the excess money. So this is like there's too much money. The banks are putting it in a one-day treasury, let's say hypothetically. This plummeted, you guys, in one day. So this is, last time I covered this, we're at 525 billion. It has sunk to $441 billion. I think this is going to be done around May, probably the end of May. I don't know, but I'm guessing end of May. It's certainly starting to go down again. It was basically sideways for a long time, stuck in the 500s, but we are now under 500 drastically at 441 billion. Once the suspension system is done, the wheels start falling off, as Danielle DeMartino Lewis, Booth, I'm sorry, what am I talking about? Mentioned to us. Now, take a look at this, you guys. The market's expectation of inflation, just when we thought, oh, we got inflation under control, it started shooting up second week of December. This needs to be down by 2 for the Fed to start potentially reducing interest rates. This has been shooting up. I'm not going to say expectations are unhinged. They do not want inflation expectations unhinged, but this is not what the Federal Reserve wants to see. This is an indication that the market is waking up to the idea that inflation is here to stay and that we will need higher interest rates for longer. And I will say, you guys, I hope people don't buy a whole bunch of houses this spring and summer. If consumers would just not obsess about buying houses, if we could just make it this season to build up the inventory, I think we're on our way to balance and recovery. But you got to stop obsessing on houses. But here's the thing. I don't want to tell you not to buy. That's your decision. So I will say, if you are going to buy, please, you guys, it's so important to use fundamentals. And it's very hard to find a house that has fundamentals like wedge and cash flow. But if you are out there, please take care of yourself, okay? We're going to listen to our last video right now. And our last video is going to be on interest rates and the fact that the Fed is going to be slow to cut interest rates. Anyone want to guess why they're going to be slow to cut interest rates? Because inflation is going to get out of control, right? Because consumers are so sensitive to rates and that sentiment, not sediment. Sediment is on the bottom of the ocean. The sentiment, just please, you guys, stop buying houses. Just for a little bit. Okay, just for a little bit. That's all I'm asking. Anyways, here's our next video right here.
Bring in Jefferies Chief Market Strategist, David Zervos. David, love to just get you first sort of your response to what you heard from Goolsbee and Sarah's analysis as well. Do you agree?
I largely agree, and you also had, I think you also had Barkin on earlier today too. So you had two Fed speakers that are important. I guess my takeaway is not that different from what you guys have been talking about today. That I think there's a very calculated, relatively slow rate cut desire. But I was taken by Goolsbee's comments, or Austin's comments, about the supply side. He really pushed on this supply side story, saying that what we saw with the negative supply shocks and the creation of inflation were a lot of follow-on effects. They'd hit in one industry, go to another industry, go to another industry. And he sort of talked about the reversing of that, which opens up the door that maybe some of these sort of positive supply side surprises, which have been the real story of 2023 that have created the lower inflation, have some more knock-on effects. So I think he's still looking for kind of a Goldilocks outcome for a while longer based on that view. And therefore, I don't think there's a big rush to do anything, even though, you know, he is talking restrictive, and worried that they might make a mistake on the other side. So he had the typical economist on the one hand.
On the other, makes it fun. David, here's the thing. They don't know when they want to start cutting, and the market doesn't really know when the cuts are going to start because we just don't know how the data is going to shake out on the, you know, this hotter inflation January, I think, threw the market for a loop. And now we wonder if it's going to stay stubbornly high, if it's going to tick up a little bit more, if there's some sort of acceleration building in parts of the services economy to start the year. It just feels like we have these big question marks and we have to wait for February and March data.
I think that's probably right. And the PC was probably a little bit better news, or at least not bad news. So that was good. And you pointed out, Sarah, the prices paid index today was lower. So that was good. And certainly the expectations data in Michigan were okay. So I think we're on the right track. We've fallen from 9% inflation to 3.1% inflation over the last 18 or so months. It's been a big move. It's been very positive. I think everybody's feeling very good about it. Whether it takes a little longer to get on the trajectory that they're happy with cuts for, I don't know. But I come back to kind of our views that we put out at the beginning of the year, which is that it doesn't really matter when they go or how much they go. The reality is that they can go, that there's a backstop in the market. If things get really messy and there's a shock of some sort, whatever that is, geopolitical, environmental, viral, all those things, we can respond again. In 2022, the Fed really couldn't respond to anything negative because they had to fight this inflation battle. So it's not a kind of if they will cut, it's that they can cut. And I think that's a very supportive thing for the market. It's an insurance policy that we have.
We got a lot going on still, guys. I mean, that's the reality of this situation. And honestly, I want you guys to come back for Friday, because remember, on Friday, I'm going to teach you guys how to use data to find the deal. Because remember, all housing markets are different. You can't really understand what's going on in a housing market by just looking at Redfin data. And, and I saw a comment here, I don't know where it went, but not all places in Austin are going to be crashing in prices. You have to do, I say this all the time, you have generally, like 90% of the time, you have to do a market analysis on a subdivision. It is so hyper-local. You must do that comparison on that subject property's subdivision. And you want to look at comps or homes that have sold. And honestly, if you can access the information, the subdivision information, everything else is simple math. You guys, everything that I'm trying to teach you guys and show you guys how to find a great deal, it's simple elementary school math. The thing is you just got to do it. If you just do it, it's going to help you. Now take a look real quick. Let me now, and I have a link. This is my home buying course. By the way, we have almost 1,300 people that have taken this course. But you guys, look at purchasing power, credit, income, assets. I got quizzes on mortgages, payment, price, investor mindset, wedge basics, cash flow basics, what to ask a seller for. You guys, I'm trying so hard. I don't know, man. I'm trying so hard not to be one of these grifters like you see all over YouTube. I'm trying so hard to give you guys my soul because I don't want you to be hurt. I have to support my family, of course, so I can't afford to keep going on these road trips, but I'm trying to help you. I'm trying to help you. You don't have to learn how I learned. You can, if you want to buy right now, so be it. I don't think people should be buying real estate right now, but I do believe that if you have empowered yourself enough, you at least will be able to determine if you're getting a great deal, a decent deal, or a bad deal. And so I feel like so long as I've given you that help and that guidance, you guys, I mean, I've done my job. It's up to you to purchase at that point, but at least you know how. So anyways, guys, let me throw up a couple comments here. We'll do some Q&A real quick, and then we'll end this out. Okay, so the first one here we have is how you have so much energy in the morning. I need 2 hours. Oh, I got up at 3 o'clock. These lives are really hard to do. I already recorded 3 videos as well. So I recorded 3 videos. By the time it was like 6:30-ish, I already recorded 3 videos and I had all the live. I get up very early. All right. Anyways, housing stocks are soaring, but Warren cashed out recently. Okay. I just did this video yesterday. Warren Buffett sold, and he had most of it in DR Horton. He sold all his stocks. And Warren Buffett doesn't usually sell so soon. He usually holds. His philosophy is if you see yourself investing for 10 years or don't invest at all. He sold already. He doesn't have home builder stocks. Warren Buffett's out. He left the housing market. Warren Buffett's gone. I did that video. Good comment. Good comment. I'm glad you brought that up. Okay. I don't know about this. How about the California bill that would allow, I'm going to say, undocumented people to qualify for FHA loans? I don't know. I don't know how that would be possible because it's a federal thing. It's a federal loan, right? Federal Housing Administration. I don't see how California can impose a state requirement into a federal guidelines. I don't know, man. I mean, hopefully that's just some California psychoness. You know, California's kind of crazy. I'm from California, so I have a right to say that. Now pivot, unite. He's saying unite us. I don't know if you guys seen Braveheart. Great movie, by the way. Didn't really like the ending, though. That was pretty sad. Anyways, unite and do not buy at this time until they are forced to come down. But unfortunately, that's the thing. In this country, people are indoctrinated with the image of the dream, and they dig graves for themselves. I think that's a great statement because, like, when I'm implying that most of us should be waiting, I'm not saying forever. When do the bulls say, "Oh, you guys are gonna be stuck on the sidelines, you're gonna miss the opportunity"? Where I'm not saying that. I'm saying as soon as I can get off the sideline, I'm off. I'm looking every day for a house. I've already put in like 5 offers since I've been doing these videos. You guys have to figure this stuff out for yourself. I'm just trying to kind of guide you. But the thing that I like what he's saying is basically the market has used the American dream against you. So it's using that premise of American dream to fear of missing out. And I want you guys to be careful. And that's why I want you guys to trust yourselves more than the realtors. With all the BS of owning neighbors, HOA tax, repair, renting, and deploying your capital in other sectors is totally acceptable and good in many circumstances. And that's the thing, you guys. And that's what the bulls that don't listen, they fume emotion out of their mouth. They're not listening to what we're saying. We're saying that if you are on the sideline, what matters is how you're waiting, what you're doing on the sideline. Are you improving your credit, your income, and your assets, right? And that's why I have that free home buying course. So if you are on the sideline, take the free home buying course. Why else would I have made it? I have to pay for that course, so I hope you guys are taking it. Don't lose hope, you guys. I think rates are coming down eventually, but prices may stay up. I hope they go down. Property taxes keep going up. And the reason I put this up is because don't lose hope. A lot of people are like, well, what's the good news? The good news is you're aware, and because you're aware, you can chill out. You could do something about it. I'm doing something about it. Don't lose hope. Just adapt to the challenges. And sometimes all we need to do to adapt is have patience. And change your spending habits for the love of all that's holy. Please change your spending habits. So here's a comment from Easy Fun Money. He's basically saying that new home builders are slashing prices all over the place. Last comment from Living in Omaha, David Travis. What about the demographics? Now, we have the largest segment of today's population entering peak buying age. Okay, so he's saying millennials, but the thing is, Living in Omaha is they're priced out. What I'm more interested is as far as age demographics. I don't know if you guys have heard, and I just did a video on this called the Silver Tsunami. Fannie Mae came out with a report. Fannie Mae, and basically said within the next 10 years, we're going to have 9 million new listings from boomers alone. 9 million from boomers alone over the next 10 years, which means, according to them, we're going to have 900,000 extra listings per year. That's about 20% more listings, right? Because if the average sales was 4 million, 1/4 of that, 25%, I don't know if I just did that math right. I kind of had a brain lapse right there. But my point is, guys, is demographics are important, but it works both ways, right? So the thing is if, again, you're a millennial, you're a young person on the sideline, I feel so sorry for you, but don't lose hope. Just improve your situation. Remember, it took me 9 years to get out of the hole I dug myself. 9 years. And so people are complaining about 9 months. You guys, I was in the ditches for 9 years. I still have empathy for you. But look at what I had to go through to finally be a homeowner. 9 years of hell, and you're complaining about 9 months? Come on. Stop with the instant gratification. That's my only point there. Anyways, guys, happy Monday. You guys have a great week, like Tony the Tiger. Remember, if you are out there, use the data. Don't use your emotion. If you're on the sideline, increase your purchasing power. Understand subdivision analysis. And obviously, go love some people. And if you're out there, you guys, first of all, thank you for joining me. Come back on Friday. I love you guys. I'll see you in Discord. I'm sure we'll be talking throughout the week. Stay tuned for some pretty cool videos that are coming out this week. And other than that, if you're out there investing in real estate, you guys already know I wish you luck and I hope. Oh, and watch Powell on Thursday. Sorry, that was it. Watch Powell on Thursday. Sorry about that. Don't move. So watch Powell on Thursday. He's testifying in Congress. And I hope you win.